I think the big drivers of this economy are AI and kind of fiscal initiatives. That's the main thing that people should be focused on. The next big driver of this bubble leg is that Trump is desperately trying to figure out a way, how do we unlock the $12 trillion in tappable home equity on the U.S. consumer balance sheet? Because I think the goal is to have this economy just totally firing on all cylinders in next summer ahead of the midterms.
Mel Mattison is a writer, investor, and fintech executive with 25 plus years in U.S. financial infrastructure, a former CEO of 3 broker-dealers.
He brings deep expertise in private equity and macroeconomics. He's the author of Quaz, a financial thriller exploring the future of quantum AI, central banking, and blockchain.
Yesterday, I was buying puts for the first time since, the January-February timeframe, pre-Liberation Day, because I believe tariffs ultimately are deflationary because they're essentially taking capital from the private sector, moving it to the government in the form of a tax. There is one major inflationary aspect to AI, and that's energy costs. We're simply not going to have the energy that we would like to have. I think that is the reality. If I look out over the next 12 months and think, what could be something that could cause another larger pullback, not just a 5 or 6% pullback, but something that's a larger, more of a 15 to 25% pullback, I think it could be around energy and the concern that energy is going to crimp the AI story. So that's what's been really supporting the market.
Hey guys, welcome back to Less Noise, More Signal, and also welcome back to you, Mel. It's great to have you on the show again.
Thanks for having me back. Happy to be here.
Yeah, it's amazing. I had some of the listeners reach out and tell me like, you have to get Mel back on the show. It was amazing, your first episode. And so this obviously is what I want to do now. And it's great that you have the time to come on again. There's so much to talk about. We were just chatting sort of offline, the tariffs and then the economy, which is slightly, or the markets, which are slightly down at this point in time. But maybe, we can just, I don't know even where to start. Maybe the tariffs discussion would be an interesting angle to start, because maybe just quick context, we have national days today in Switzerland. Everyone is off celebrating. But last night, Trump came in and he was like, Switzerland will be hit with 39% of tariffs, and everyone is outraged over here. It's like, what is he doing? And so you had this interesting post saying like, tariffs are not the story this year, neither is the Fed or the Fed funds rate, And so maybe if you could sort of unpack this, that would definitely be interesting.
Sure. So I do not think that tariffs are meaningless, and I'll get into a little bit more of what I think their meaning is, but I do not think that they are as significant as the media has generally been making them out to be, nor as significant as the market thought, earlier in the year. And I think a lot of people have kind of come to that conclusion as well over time. And I mean, just roughly speaking, and this is kind of ballpark back of the envelope type stuff, but if you look at the U.S. economy as a roughly $30 trillion GDP economy, that 10% of that, which is 300 billion roughly, is coming from imports, right? Or excuse me, 3 trillion coming from imports. So if you've got 3 trillion in imports, then let's think about where this overall effective rate settles. And if you think he's putting on around 15 to 20% on average on our biggest trading partners, some trading partners like Switzerland, which are smaller for the U.S., might be getting higher. But what's that going to overall lead us to? And I think it's probably going to lead us to something in the neighborhood of a 12.5, maybe 15% total effective tariff rate. I don't say 15 to 20% effective tariff rate because there's a lot of exemptions as well within that. So you have certain things like airline industry. We want to keep Boeing going, so there might not be airline tariffs with the EU. I believe airline parts are exempt from the EU deal we just did. So you're not going to get that full 15% or 20%. So let's just call it 12.5, maybe even if we want to be generous, 15. We're already at a 2.5%, 3% effective rate. So we're talking about somewhere a 10, maybe 12.5% increase, which would be something around 300 billion to maybe 350 billion in additional tariffs. Now, that's significant. That's 1% roughly of a $30 trillion economy, 1% of GDP, $300 billion. It's essentially a $300 billion tax, though, in my opinion. And that's really where I don't kind of understand where the Fed is coming from. I think they're trying to defend themselves after their transitory mess a few years ago. But at the end of the day, a tax is actually deflationary. It's taking money away from the private sector. And while we might see one-time price increases on certain line items in the, consumer price index or the producer price index, and I say those names because that's what they are. They're price indexes. They're not inflation readings. Inflation is more of a monetary phenomenon where you start increasing the money supply and you get more money chasing the same amount of goods and services. This is more like a tax. And in fact, if it was done after the fact, meaning, let's say they were charged to the consumer like a sales tax is done after you ring it up, I mean, it wouldn't even show up in the price indexes. So it's kind of an embedded tax, a tax that gets embedded in the price, but that's not really inflationary. And so to the average consumer, it might feel like inflation. They see a Swiss watch go up to 25, 30%. They say, okay, this is inflation. But from a monetary perspective, it's really not. And so I think you cannot look at things, because I've always talked about big fiscal deficits, helping to pump GDP. You can't have your cake and eat it too. I can't come on the air and say, oh, well, we've got a $2 trillion deficit, and so that's helping to juice the economy, and then say, oh, there's going to be an extra $300 billion in taxes via tariffs, and that's not going to have an effect. I think it is going to have an effect, but that a lot of that effect is going to be offset by what we're seeing happening with AI, particularly the massive amounts of CapEx. Just this week, as we record here on August 1st, Friday morning in the US, we saw, massive earnings beats from Meta and Microsoft. Apple's okay. Amazon was not doing well. We can get into what I think is going on there if you want. But I think the bottom line is that CapEx on AI spend was increased. The hyperscalers want to build these data centers. We don't have the energy grid to supply the energy we need. We're going to need to be doing more of those infrastructure type activities. And we've probably got another one, if not two, reconciliation bills that the U.S. Congress is going to try to get through before the midterms. That's going to probably have more spending added to it. So when you take the 100% depreciation on CapEx, which is part of the One Big Beautiful Bill, you look at the AI spend, I think that's going to offset a bit of this tariff, and that's really what's going to be driving the economy once those tariffs kind of settle out their one time going into 2026 and 2027. So I think while they're meaningful, they're not very significant. And I think the other thing that's a much bigger story, like I said, is just AI, both in the spending, the productivity increases, but also the deflationary aspects of AI, which I think we're starting to see this morning in the jobs report. And we had massive revisions of over 250,000 less jobs in the prior 2 months, and an increase in the unemployment rate. And I think this is basically saying, look, we've got a strong kind of CapEx cycle coming, but the labor market is not extremely strong. And I do think that's going to lead to a Fed cut in September. But I think the big drivers of this economy are AI and kind of fiscal initiatives. And that's the main thing that people should be focused on.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yeah, these are some great points. It's probably true that in individual cases, when it comes to, as you elaborated yourself, with individual prices and then individual people as well as companies and even countries, tariffs might be a drag on them for sure, and there's going to be some hiccups here and there. But if you approach it from a big picture view, and that's what I'm hearing when I listen to you, it's really like there's so many things that can potentially and probably will offset the disadvantages that we will have from a macro perspective coming from tariffs. There's the physical backdrop that you mentioned as well. And so, yeah, in the end, it's probably also discussion of how much is the real world economy in that sense still driving the financial markets, because that's what I'm always wondering. It's like these sort of bad news that we're hearing like now from Trump, from politicians. Obviously, this has some short-term effects on the markets, maybe even on the economy as such, but then we go back to normal, and with tariffs, I had this feeling that in April, it was like all bad. And now you see the markets sort of getting comfortable with it, even with further announcements and so even sort of calling the bluff. And as you say, there's so many forces that might counteract this. So that's what I think is also very interested in this, right? Would you agree that like markets are sort of independently from the real economy to a larger extent than maybe 20, 30, 50 years ago? Because of the things that you were mentioning as well, with physical backdrop and everything that's going on.
So compared to 20 to 50 years ago, you're asking if what has changed exactly?
For example, if it feels like that's an argument many people make today, the financial markets are less and less really dependent on what's happening in the real economy, and what is impacting the real economy might then not also be bad for sort of the financial markets, and there's sort of a mismatch there between financial markets and the real economy. And I was wondering if that has increased, or what is your view on that?
Well, yeah, I mean, there's always been a little bit of a dislocation between what the economy, as far as what we might think of as the real economy. Like, for example, as manufacturing has become less and less important to the United States. If you look at, the amount of S&P 500 revenues, for example, that also come from outside of the United States, it's like 40% of revenues. So what's happening on the ground in the U.S. with, maybe Rust Belt cities or, in the nuts and bolts of your average American can be very different than what these large corporations are pulling in from an earnings perspective, especially when you look at these, the indexes being dominated by these mega cap companies that just are printing money. I mean, the operating margins at NVIDIA are massive. I think they're in the 70-80% range. So you've got very high margins with the other ones as well, whether you're talking about Apple or Meta or Google or Microsoft. So you've got these companies that are just pulling in massive earnings. They're having huge earnings and revenue growth. even these large companies. And that's why Meta and Microsoft, jumped so much after their earnings on Wednesday is despite the fact that these are huge companies, they're still putting up 15, 20% year over year growth. And so when you're getting the earnings growing, and then you add into that, and this is where I think there's been even more dislocation from the real economy, is you look at what I call the quasi Ponzi structure of the S&P 500, which to me, it's like a never ending Ponzi scheme. Like the Ponzi scheme is basically new entrants come in, put in more and more money, and that allows people that got in earlier to pull that money out if and when they want. And those Ponzi schemes like Bernie Madoff, they can work for a long time until, the market collapsed. And what's happened in the United States, especially with the passive flows, I mean, people, they start a job in this country and you're automatically enrolled in a 401k. There's an automatic deduction of your paycheck, and that's going automatically into the S&P 500 and NVIDIA and Microsoft and all of this. And it's the same thing now. We've gotten the one big beautiful bill, these MAGA accounts, where every child that's born is going to basically start investing in the S&P 500 from their day that they come out of the womb. So, I mean, this is just the flows are just massive, and the investors, especially retail investors, have simply learned that anytime they panic and sell, they're doing it at the wrong time. And then 2-3 years go by, and a lot of times a lot less than that. Sometimes it's just 2 or 3 months or 2 or 3 weeks, and the market is higher than where it was before. And so they're no longer selling. And so you're getting this almost inelasticity in these indexes where they're having these very sharp corrections, but they're tending to be V-shaped rather than long, bumpy, multi-year, prolonged downturns. And this is not only because of this kind of investor behavior, but I think the federal government itself has recognized now, after seeing tax receipts go down and after the 2022 market decline, which was a little bit more prolonged, that anytime you have a prolonged, decline in the S&P 500, you actually start to blow out deficits, which then leads to trouble in the bond market. And so there's almost a political necessity now not to allow the markets to go down and stay down for prolonged periods of time. And so I do think you will see pullbacks. I think, as we're recording right now, I think we're at the beginning of a small pullback, a 3.5 to maybe 6.5% pullback. That's going to take us from a high yesterday. We got to 64.27 on the S&P. I think we can easily test go back to the February high, which I think was 61.47. So that's like a 3.5, 4% decline. Maybe go all the way back to say 6,000 even, which would be like a 6.5% decline from the high. So something in this, call it 3 to 6% range makes sense. But I think this will eventually get bought, and then we will march higher into the end of the year. And I do still hold to my 7,000 price target by year end on the S&P. I just think actually yesterday I was buying puts for the first time since the January February timeframe pre-Liberation Day, because I did feel like, okay, we're getting near overbought on the weekly RSI for the S&P. I had thought we were going to hit 6,500 this week. We got within 70 some points of it yesterday and started to roll over. And I thought we could still hit 6,500 if Apple and Amazon had blowout earnings and the jobs report was good. It wasn't. And so I think that 6,500 is off the table for now. I think we're in pullback phase for at least the short term. And then, we'll hit 6,500, later in the summer, probably early fall, and start marching back higher. So this market, while it does have pullbacks, it's not a straight line up. There's going to be volatility. I think the underpinnings of it, which are AI CapEx spend, big fiscal spend still there, despite the extra $300 billion in tariff taxes. And then, when you look at the U.S. consumer, the job market, while it is weaker, and we have not had really good job gains in the last few months, especially after these revisions come out, I don't think it's falling off a cliff. And we're seeing companies do some layoffs, not huge, not hiring as much. But as people have talked about, and as Powell talked about on Wednesday, there's also been a reduction in kind of the labor supply, which is a function of immigration being cut off, as well as the demographics of the
Mhm.
United States, which is the baby boomers, retiring and saying, okay, it's time for me to get out of the workforce. So when you combine that, I don't think we're going to see a spike to like 5.5, 6% unemployment, big recession. But I do think what we can do is we can get into a little bit of a Goldilocks position for the markets, where we're going to have maybe some one-time price increases, but not true monetary inflation. We're going to see services inflation continue to decline. The Fed is going to be able to start cutting in September, I believe. And then we're going to start having some of these positive effects from the one big beautiful bill that was just passed with more CapEx spending. There's going to be, like I said, infrastructure bills, maybe potential goodies coming in future reconciliation bills. And all of these things combined with the the switch from we're going to try Doge or some sort of austerity move to get the fiscal house in order in the US to we're going to try to, really grow GDP. And I think that's what Trump wants to do, as the administration wants to do. And I think this whole process is really just getting starting and ramping up, and we're heading into a long-term bubble period. It doesn't feel like it this morning with the markets down over 1%, but in the big picture, I think these are ultimately buybacks that should be bought, not today, but as we get nearer those 6,100 levels I've been talking about, 6,000, 6,147, something in that range. I think you're going to see people stepping in and buying here.
Mm. Interesting, very interesting. I mean, and this bubble territory, that or trend even that you're mentioning, that as I hear it, we're only just sort of entering it, or we've been it, but it's even accelerating. I mean, one question that I'm hearing a lot from people who are watching the markets is like, people like to think in cycles, like there's going to be a cycle, and at some point we're going to be late cycle, and then the cycle is going to be over, and then there's going to be a trough, where we have to sort of, yeah, go beneath our means, so to say. So the question I'm having, is there any merit in your view to this cycle thinking? Like Michael Howell, for example, he has this liquidity cycle that he's tracking, and he's like, okay, in 2026, there could be some the undercurrents could not be that good anymore, and then we could hit some obstacles and stuff. And so are you a believer in this cycle theory, or are you more of a person like, no, worry about the things once we get there? Don't, as an investor, think about the here and now, and not like project out even 1 year, because it's just not worth it. Anything could happen,
Mhm. Well, I have, seen Michael Howell a few times. I haven't done a lot of research into his work that he does. From what I've seen, it tends to look a lot to me like he's kind of charting almost like coincidental indicators, where, like, yes, the stock market's always going up when liquidity is going up, because I think part of the inputs to his liquidity function is equity price. Like, I think he looks at all financial, like, liquid assets as part of it. So I think it's almost like a tautology
circular.
that liquidity is going to go up when, as the financial asset prices go up, so is his liquidity measures. And so to look on the chart and see that they kind of correlate doesn't seem to, do a whole lot for me, to be honest. But like I said, I haven't gotten into the details of his work. There may be a lot more to it than that. That's much more predictive than I'm understanding. But I I do think that the traditional kind of cycles that we used to see um, were very much driven, by, okay, there's some sort of new demand in the economy. In order to meet that demand, stuff comes to the fore to meet it. It gets overdone, and then it needs to kind of reset. And we do still see cycles like housing, for example. We had massive building heading into the great financial crisis, when housing was going into a bubble that ultimately collapsed in the 2008 timeframe. And then what happened was home builders said, wait a minute, we don't want to be building houses. I mean, there's so many foreclosures, and so we underbuilt housing, and now we're trying to, rectify that situation. Now there's other dynamics at play, like baby boomers getting older and different circumstances. So I don't know exactly how much housing supply we actually need to add. A lot of the housing price, increases, I think, are really like a function of people needing to put US dollars somewhere that will keep up with the basic fiat debasement that we see. And it's like, the monetary premium, and Bitcoin can take and is taking some of that workload away from the S&P 500 and away from housing, your traditional kind of monetary premium assets. And it's absorbing some of that. But there's still, I think, plenty of monetary premium out there that's going to be needed because of this massive deficit spending, which, despite the tariffs impact, and we did have a budget surplus in June, which was a little surprising to me. But despite this budget impact from tariffs, I think we're still on pace for very strong deficits and increasing debt loads across the Western world and developed economies. And that's, to me, is just a recipe for continued asset price inflation.
Yes, I see. Yeah, that's a great way to frame it. In the end, I think what I wanted to say is really that guys like you, and Ben Kitsamchuk, it's another guy that I recently had an episode with, and others. I think you guys really helped me to understand that I sort of, sort of abstain from thinking in these cycles, because I have like this understanding now that there's so many things coming together. It, like the flows that you mentioned, you have the fiscal dominance, we have deficit at 7% of GDP, we have the whole AI productivity booms that's coming. We have so many things that are sort of the undercurrent that's almost, it feels like a certainty that markets have to go up in the long term, and they always have, when you look back. And then you just have these hiccups along the way, where like maybe some trends, some narratives, they get overheated, they get all priced in, and then you have a slight correction, but then you have all the bears calling for the major recession coming along. And from what I'm seeing with all these undercurrents, and some of them I want to talk to you about, like the AI stuff and what's going on, it feels like, it's almost inevitable, for markets to go up. And that's why you probably have to sort of remain a perma bull in that sense. While at the same point, as you said, you put on some puts as well. There is more like periods in the market where you sort of have to turn against it, sort of, but don't bet against it for too long is sort of my question, or probably what I'm sort of arriving at ever more, and so I don't know. I feel like you have a similar take as well when it comes to it all. Yeah.
Yeah, I mean, I just think it's that when these downturns come, even a 20% correction or pullback, that they're getting shorter and shorter in duration, and their recoveries are stronger and stronger. And like I said, I think it's a function of, as we talked about, those flows. That's not to say that we can't have, significant issues at some point in the future, but I don't know what the world is going to be looking like in 2029. I mean, maybe there is, this major collapse on the horizon out there somewhere. But I think until you start to see what's the really great catalyst that's going to do this. I've seen some people like Jordi Visser talk about in the 2030s, maybe AI, that essentially very small companies with a few people are going to be able to replicate the services of these huge companies, and they won't be able to compete. And he used the term 2030s graveyard for Fortune 500 companies. I mean, maybe something like that happens, and as we're moving into a world of abundance in the 2040s, and then who knows what the economic structure is really going to be like. So until we kind of get to those points where we start seeing a major shift in the fundamental dynamics of the economic structure of global economies, which to this day is still, especially in the developed economies, run large fiscal deficits, increase debt, debase the currencies. And then you're seeing these companies now being able to improve margins and productivity with AI. And then I think the one thing that a lot of, the media is not really talking a lot about is the U.S. housing market, which is a key aspect of wealth for the US consumer. So if you look at charts of like overall US household debt relative to assets, so essentially household net worth in the United States, it's it's at an all-time high, and the U.S. household is relatively unlevered because so many people locked in like 2.5% mortgages on homes that they might have already owned heading into the pandemic that then skyrocketed in value. And I think this is the next big driver of this bubble leg is that Trump is desperately trying to figure out a way, how do we unlock the $12 trillion in tappable home equity on the US consumer balance sheet? And he keeps arguing with Powell to lower rates, and that's going to, drop the rates on T-bills and save the government, all kinds of money. He exaggerates the amount. It will save the government some money. And then people are worried, well, this could spike the long end, and that's where the 10-year mortgage is tied to. And I think or that's where the 30-year mortgage is tied to the 10-year. So I do think that, him and Bill Pulte, who's his head of housing, I think that at some point they're going to try to figure out a way to kind of override the traditional like 30-year fixed mortgage tied to long end rates in order for people to either buy a new home or to tap home equity. And I don't know if that's going to be some type of a program. I've suggested before in other expos that they're going to come up with something like a MAGA mortgage, like they came up with a MAGA account for kids, where they're like, okay, first time home buyers are going to have some type of a mortgage buy down essentially by the government, the way the home builders buy down. Like I could see Trump saying, we're bringing in so much money from tariffs. We now have 300 billion extra that we can essentially provide as a home incentive program, or something where Fannie and I think this is going to happen. There's a pilot program that I believe has been in place for like over a year now, maybe, of Fannie and Freddie guaranteeing second mortgages, where they're putting the government imprimatur on second liens on homes, which could drive down refinancing rates. And then the other thing that I've talked about before is that home equity lines of credit to tap this equity are tied to the short end rate. And so if you do get the Fed funds rate down, it can drive down the floating rate HELOC rates and allow existing homeowners that have hundreds of thousands of equity in their homes to say, oh, I didn't want to borrow $150,000 from Bank of America because it was an 8 or 9% rate. Now that rate is 6% or 5%, 5.5% on a HELOC, and now I'm going to tap that, and that's going to enable the U.S. consumer to ultimately spend. But I don't think the Trump administration has cracked that nut yet, but they're working to do it. And if it doesn't happen this year, I think it starts to happen next year as Trump gets the opportunity to put in his Fed share.
Yeah, that's as you just explained. I think that's probably one of the reasons why they want to bring down these rates. To really unlock the financing side of housing. I mean, what they also sort of are considering is no tax on capital gains when it comes to home sales. How would that help in your view with that problem that we're faced, or in the US you guys are faced with?
Yeah, so in the US, it's kind of a very particular law, which is essentially on a primary residence. I believe if you live in that primary residence 2 of the last 5 years, you're exempt from, I think, 250 as a single person or 500,000 in gains. So somebody like baby boomers, for example, might have bought a home for 150,000 that's now worth $1 million. If they were to sell that and have, 850,000 in gains, 350,000 of that would be a capital gain, and that would be taxed. And so there's by taking away capital gains, you're kind of incenting people in that situation. I don't know if they've talked about applying this to investment properties, because in the US, if it's not your primary residence, any gain you have is taxable. So you could have bought something in COVID in 2020 as an investment property. It's up 300 grand. You're thinking of selling it, and and if they take away that capital gain, that again, it could put more supply into the market. Now Now, for investment properties, we have something called a 1035 exchange in the US, which allows you to sell an investment property and roll those proceeds into a new investment property and keep the old cost
Yeah.
basis. But I think what Trump wants is like money in the economy, and that taking away that capital gains tax on housing, I think would actually be a pretty big deal because it would free up these baby boomers to say, let's sell. We can get all those gains and move into a condo somewhere, and buy it all cash. And then the other thing is like some of these people that have investment properties that maybe are realizing investment. I own some investment properties. There are a lot of headaches a lot of the times. Hey, this is my chance to get out of it, cash in my gains without taxes. And that would put supply into the market, open up housing. And so I do think like housing is really going to be on their agenda as they're working through the tariffs, they're working through that one big beautiful bill. They're doing crypto, and they've also got housing on their roadmap of how do we unlock this? How do we figure out how to, because I think the goal is to have this economy just totally firing on all cylinders in next summer ahead of the midterms, so that Trump can go out there with senators and congressmen running for office and say, look at this amazing economy, 4% GDP, housing's unlocked, we're getting people into homes, we've got, good tax receipts from my tariffs, I'm not blowing out deficits, things are amazing. And that's what he wants to be able to say. And so, especially if this housing report is a sign of weakness in the housing employment report, is signs of weakness in the labor market. If people are worried about their jobs, they don't want to spend money. And so I think he wants to make sure that anything he can get his hands on to keep the consumer spending there, he wants to put it in place. And baby boomers, they're not worried about the labor market, and they have a huge amount of the wealth in this country. It's completely skewed. I think it's like 70% of the wealth in the United States is owned by people 55 or older. And so, that's where the economy starts to look different, where you're like, oh, if the labor market weakens, we must be heading into a cycle of a big recession because consumers are going to be worried about their jobs. Well, if most of the consumer spending is coming from people that don't care about jobs because they're retired, then those old time correlations start to break down. So you have to look at the economy the way that it is now, not try to look at graphs from the 1980s and say X happened in 1980 and then Y. Therefore, if X happens today, Y must happen today.
Yeah, geez, makes a ton of sense for sure. Very, very interesting. I mean, just quickly to your earlier point, about the backdrop that we're living in now, which is also, as you just said, so different to maybe 20 or 30 years ago. I have a colleague on X, and he calls it sort of fatalistic bullishness, and I think this for me at least sums it up perfectly, because as you said, there's the monetary backdrop with the inflation, the debasement that's going to happen, but at the same time there is like the technological revolution that is going on, and so this combined is sort of, as I said, this fatalistic bullishness that I also nowadays sort of adhere to. So yeah, it's just lining up perfectly. You mentioned interest rates, a September cut. How
Mm.
likely do you think will they cut in September? And then also, what's your view on inflation? Because to me, higher inflation seems almost inevitable at some point, because only if you project out what's currently happening with the Fed government on the level, Powell, Trump, the whole schism or whatever there is. So, yeah, just curious, what are your thoughts there?
Mhm. Yeah, I mean, at the very beginning of the year, I predicted 100 basis points in cuts, and I've basically been sticking with that. I think it it could possibly just be 75 basis points, but it could still be 100. We could still get 100 in the same way that we got 100 last year, which was 50 basis points in September and then 25 in the last two meetings of the year each. Mm, I don't necessarily think that's likely, given what Powell said on Wednesday. He still seems to have this Paul Volcker 2.0 mindset that he's never gonna he's gonna keep fighting inflation until he gets kicked out of the chair. But basically, I do think there's a very good chance that it's going to be 3 cuts, and they're going to do September, and I think it's in October and December meetings we have left. In fact, in the prediction markets, I've got a decent sized bet on, because the odds were only 8% that there would be exactly 3 cuts this year in the prediction markets. And I think those went up today after the jobs report. People are saying, oh, maybe they are going to cut at all 3 meetings that are left this year. So I think that's a good bet to make. I don't know what the odds are at as we're speaking, but I think they're going to cut at every meeting heading out of the year, because the labor market is what Powell does always come back to when he says, on Wednesday, he said, I still see downside risks. I don't think he saw this morning's report on Wednesday. I think if he had, he would have been a little bit more dovish. I had said before the meeting, I don't expect him to make any type of commitments on Wednesday because he doesn't have to. He's going to have that opportunity to see more data, but then he doesn't like to surprise markets. So if he is going to cut in September, or the committee is, he's going to want to telegraph that next month or later this month at Jackson Hole. And so I think this Jackson Hole speech, it's an annual big central banking meeting they have every year in Wyoming here in the U.S. I think he's going to come out there and kind of introduce September as a truly live meeting. I think the 2-year and the Fed funds markets are already pricing in. That's the most likely case that he's going to cut in September. If he doesn't, then I mean, he's really, to me, just gone off the deep end with his kind of tariff derangement syndrome that he has. Because, and I understand that, because Trump, I mean, he sent out a truth post the other day calling him too late, too stupid, calling him a loser. I mean, Trump, I don't understand why he does this stuff, but I mean, he really makes these personal attacks on the guy. So I understand if he wants to kind of be like, he has this very nice grandfatherly way about him, but he's kind of very firm in a sense, in a way that I did not see like last year under Biden. Like, to me, he was always kind of looking for a reason, like to maybe cut rates, and we saw him cut 50 basis points in September. And so he was kind of willing to do that. And I think what he was doing is he keeps talking about like inflation expectations. Well, we did get inflation expectations that just this morning, right before we came on, and they did go down on the 5 and 10 year inflation expectations, I think, on the UMIS survey. So I do think inflation expectations are coming down. And I don't think they're understanding AI yet. I don't think they understand how deflationary that could potentially be, how potentially damaging that could be to the labor market. And if they start to wrap their heads around what this could mean, then I think that they have to say, why are we being restrictive? I'm not saying they need to be easy, but why are they being restrictive? Get down to the neutral rate. And you're just not seeing, like I said, inflation, and that indeed, I believe tariffs ultimately are deflationary because they're essentially taking capital from the private sector, moving it to the government in the form of a tax. So if you've got all this going on, I think the only reason he's being so kind of hard-headed, I think, about inflation is that he does not want to have fought inflation for all these years, and then at the very end of his term, essentially cut rates, looked at as having caved, and then at some point next year, inflation starts coming back. Because I do think ultimately we're in a higher inflationary world, not a hyperinflationary world, but it's just difficult to get inflation, below 2% until tons of these AI productivity increases really come into place, which is probably years in the future. And in the meantime, there is one major inflationary aspect to AI, and that's energy costs. So that's what we saw in the latest CPI and PPI. We had a 14% jump in nat gas prices, energy prices as part of the goods component in CPI year over year. In PPI, energy was what was really driving that. It otherwise would have been negative. And so I do think that energy is this AI and energy, that like, how do we figure out energy? How do we supply what we need for AI without driving energy inflation? Because that then feeds into everything. That feeds into the, energy costs that an automobile factory needs to pay in their bills to run their manufacturing. So these are the the dynamics at play, and it's not an easy mix to figure out. But I just don't see any reason to be restrictive because a higher interest rate isn't doing anything to keep natural gas prices low.
Mm-hmm. Yes, you mentioned the electricity and energy problem, that it could almost turn into a stumbling block at some point in the future. So I want to talk about this as well, but maybe quickly stay with the Powell Trump situation, because you had some posts on Fed independence and what's going on here. What is your view on this entire theater? Is it all
Wow.
just like a show, so to say, that they're putting on, or is there any merit to it? Or yeah, and couldn't that also be like a drag where trust is just kept on being lost, into
Mhm.
U.S. institutions? That's at least what I'm hearing throughout Europe as well. Like people are looking to the U.S. and they're like, "Wow, like legal uncertainty is increasing with this. You don't know. Trump is just like back and forth, and he's even doing this with his own people, so to say." So, what is your take there?
Mhm. So this is one of those kind of paradigm shifts that I think, it probably started, 54 years ago in August 1971. We're coming up with, say, August 1st. So, August 15th, I think, 1971, um, when we went off convertibility of gold. We really, I think to look at, say, a short-term interest rate, I think if I raise that short-term interest rate, I'm going to tamp down economic activity. That would make sense in a world where you had a bunch of industrial manufacturers that were, say, taking floating rate loans to build a factory. And now the interest rates are higher. So I'm not going to build as many factories or something like that. I think if you look at the bulk of GDP activity, right? You have the government's like 24%. You have, private sector in consumer spending. You have these relatively asset light, tech companies going on, and you have a bunch of services economy in the US. These are not, I don't think that the Fed funds rate is really tamping down a lot of the activity. And I think having it over 4% is actually probably feeding into inflation more than it's cutting down inflation, because what that's doing is it's just allowing a lot of these people, like we talk about, these baby boomers that are retired that might have money in money market accounts or T-bills. They're getting that income that they weren't getting, just 3 years ago, where it was like 0% returns on cash. And they're taking that money and they're going on their ski trips to Vail or what have you. So I think that, ironically, if he lowered rates, there would not be an inflationary impact from it, because it would take away some of this what I call interest rate stimulus, where
Mhm.
all of this money that the government is paying out in interest expense, over $1 trillion a year now, 75% of it is domestic holders, about 25% foreign holders. So we're talking about like an $800 billion basically being fed into the US economy from the government interest expense every year. That's the same size as the TARP bill that bailed out after the GFC. So we have this embedded, essentially, stimulus into the US economy. If he lowers rates, that takes some of that stimulus away. And so I think that it wouldn't be like an inflationary kick. It would take down that. It would start to unlock a little bit of the housing activity, like we've talked about, which would get more money into the system, and that does tend to be, inflationary. But I don't think that we're talking about taking rates back to 0 or 2% mortgages here. It's just going to incrementally increase the tappable home equity that can keep the consumer kind of humming along as we get into this time frame of lower job creation because of AI. So all of these things, I think, do eventually lead to this very good picture for risk assets, which is, um, still slightly inflationary backdrop from the energy on AI. So staying in the, what I would say, 2.5 to say 3.5%, core PPI, CPI, PCE type prints. And then you get the fiscal largesse from things like the One Big Beautiful Bill. You get the CapEx spend from AI, and then you're going to try to get this housing unlocked. And as long as the labor market doesn't completely collapse, which, as I said, I don't think it will because of demographics and immigration changes, that, and the fact that most of the consumer money in the U.S. is in retired people's hands anyways, then I think you get a situation where you could get even more kind of wealth inequality in the short term, where you still see, people that are living paycheck to paycheck, disappointed because, beef prices are going up, their wages are not skyrocketing because of AI. And so that's going to be another thing that Trump is, I think, going to try to address. And he might even try to address that by drastically decreasing uh, personal income taxes. So he's talked about wanting to end income taxes on people that make, like, say, less than 75 or $80,000 a year. And again, I think he's going to try to milk everything he can out of this $300 billion in tariff taxes and say, look, we've got this tariff tax revenue now. We can decrease personal income taxes. And so, along with getting rid of capital gains on houses, I think you could see an attempt at another tax cut, a further tax cut for especially lower and middle income households heading into the midterms, which Speaker Johnson could try to pass through on another reconciliation bill before November 2026.
I see. Very interesting as well. I mean, from what I'm hearing, I'm also now asking myself, because I heard some people say this, and I'm not really sure what your definite opinion on this would now be. Like in terms of the yields currently out in the market, some people are arguing the yields on US debt, on the short end it's too high, while on the long end it's still too low. When you take this market perspective, and do you agree? And if so, how do they thread the needle, like the administration, on massaging the long end higher, while the short term also lower? I think some of the things you already mentioned, but how do they do this without wreaking havoc, so to say?
hmm Well, I do think, we had the Treasury quarterly refunding announcement come out this week, and they did increase the size of Treasury buybacks. They also talked about buying, like, on the run treasuries for the first time, which they used to do buybacks to essentially, there might be a weird maturity or a weird interest rate out there, and buy that because it's not very liquid. Um, I think the Treasury is getting more involved in yield curve control. So a lot of people have talked about this, that part of this, trying to thread this needle of how do we get ourselves out of this debt to GDP a hole and grow our way out without skyrocketing the long end. I think, obviously they're doing large amounts of bill issuance. That's part of it. I think they're looking at the Genius Act as getting in the stable coins. We're seeing an increase in Treasury buybacks. And, ultimately this could come into a position where, you're back to QE, you're back to the Fed, buying bonds. We've also, heard talk about, the exemption on the or treasuries from the supplementary leverage ratio for banks. So trying to find places to stick all of this treasury issuance without skyrocketing the yields. And one of the things that I honestly do believe as well is that I've talked about this with Fed independence, is that if you look at, say, U.S. history, we've had four different central banks. If you go back to, the Continental Congress creating the Bank of North America, then we had the First Bank of the United States, then we had the Second Bank of the United States, which was ended in 1836. Andrew Jackson paid off the debt and basically got rid of the central bank. And then we had the Federal Reserve come in 1913, the same year that we had the income tax put in. And I think if you look at all of that, and you look at even throughout the history of the Fed, where in the 1940s, essentially the Treasury dominated the Fed. If you look at all the periods when we didn't have a central bank, if we look at periods when the Treasury dominated the Fed, this idea that the U.S. got to where we're at because we've always had this amazing independent central bank just isn't true. Most of the time we haven't had. And the second largest economy in the world is China, and they do not have an independent central bank at all. The People's Bank of China, by law in China, answers to the chairman of the Chinese Communist Party, Xi Jinping. So there is evidence that an independent central bank is not, and a lot of people in the media are like, oh my gosh, if you get rid of Fed independence, everything's going to collapse. And I would say if you look at the 1940s, we had one of the greatest economies in the United States. We didn't have an independent central bank. You look at China, they don't have and so I think it's a lot more hullabaloo about nothing. I think it's kabuki theater. I think it's, and a lot of even the main media now are saying like more and more Fed irrelevance, that the Fed just isn't what it used to be, getting away from rock star central bankers. I heard talk of that yesterday on Bloomberg, that this whole thing about the central bank and every move that the chairman says, it's being more moved into the treasury as well as being dominated by, the private sector.
Yeah, it's so fascinating. It's really this sort of neat story that we've been telling ourselves. But yeah, if you look at history, even if we go way back in history, that's something I
Mm.
wanted to dig deeper with in my book. The Bitcoin Enlightenment, like the founding of the first central bank. The Bank of England.
Uh-huh.
I mean, that
Uh-huh.
bank there was no independent at all. It was founded
Mhm.
in order to finance the entire UK government or British government back then. So it's just so fascinating that we have all these stories that we tell each other, and it's sometimes not even true. But if we really follow this line of thought, and I think this is something that you were vocal about as well, like we end up at the whole MMT story. It really, they are pointing to the fact that the Fed might not be in the driving seat. It's really the Treasury, it's the government. They can do it all themselves. We don't even need this entire circus where there's a Fed, where are private banks who buy off like from an auction government debt, and then it's sort of privately bought, even though we all know they're backstopped by the Fed themselves, and the Fed is ultimately backstopped made by the U.S. Treasury, and so it's just very interesting, and it doesn't sound or bode well with a lot of Bitcoiners, obviously, when I make these statements, but I think it's so true, and that's again, people like you and others help me understand that this is just the current environment we're in. So, yeah, it is very, very fascinating, so to
Mhm.
say.
Yeah, I think the thing with MMT, and I think the Trump administration is acting from MMT principles. I think what happened with MMT is it really is a monetary kind of framework for understanding how the financial plumbing works. And what happened is the first proponents, the loudest proponents of it, tended to be very left leaning, in some cases even socialist. And so what they always did was they took this framework, which I think actually works and describes well the modern economy, and then they added on top of it a lot of policy prescriptions, like the government should take over a larger sector of the economy. There should be a job guarantee. I think you can have kind of conservative libertarian type principles, but still use the MMT framework to analyze things. And so what MMT says is that what drives inflation is when there's kind of over competition for resources. And if the government needs to do something, it can just print the money. And then if inflation comes, what you do is you just increase taxes to take money away from the private sector, and then you can control the inflation. And like the problem we had with stimulus checks during COVID was we sent out a bunch of money that added to competition for, say, goods, which were already in a supply crunch because of COVID. And so, of course, you got inflation. So it didn't surprise MMTers that there was inflation. MMT doesn't state that the government can send everybody $100,000 check and there's not going to be inflation. Yeah, not that we send $100,000, but just, I mean, some people think that's what MMT says, that the government can print as much as it wants and you're never going to see inflation. That's the point of MMT, I think, is that there's not this kind of the traditional constraint of like, let's just look at how much debt there is, and then that's going to drive inflation, or how many assets the Federal Reserve has on its balance sheet, and that's going to drive inflation. What MMT is saying is how much competition are you introducing into the economy for goods and services and resources, and how much are they competing? And you have to try to find a balance in that. And so I think that there are areas in the economy where for example, we need more power. We need electricity. The government could probably do an infrastructure bill to help fund, updating our grid, adding new power plants. yes, that's going to create an increase in, say, copper prices or construction labor because you're going to be pulling from that. So there would be kind of inflation in those areas. But on the other hand, you're going to get power plants built, which is going to be deflationary for the whole economy because we need the power supply. And if we don't increase it, we're going to get massive spikes in energy costs, which is going to be even more inflationary. So I think basically this MMT situation that Trump is operating from is also that MMT believes that, as I do, that the more interest rates you start paying out to the government, that's actually stimulative. And so that's why, lowering rates on the front end, bringing down T-bill yields is actually a deflationary aspect rather than an inflationary aspect of the economy.
Yeah, no, for sure. And I mean, to your point again, like that was great, pointing out that, like, yeah, MMT, it can be taken as an ideological framework. And I guess most of the proponents who are like MMT people, they see it as an ideological way of thinking. If you listen to Stephanie Kelton, she definitely, that's her underpinning. But I mean, you don't have to go that far. As you said, you can have libertarian principles at heart, and at the same time using MMT as a analytic framework for today, how it works. That's just so accurate, and
Mhm.
so it's sort of nuanced here. That's for
Uh-huh.
sure. I
Uh-huh.
want to go back to inflation real quick, because from what I understood, you said you expect it to be rather muted, and so you
Mhm.
brought up Jordy Visser as well, and obviously I listen to his shows that he does on YouTube every now and then, and there. I think he was all over the topic with Anthony Pompliano as well, that there will be a PMI uptick, from here. He believes into the end of the year. So sort of a reflationary boom, and
Mhm.
also with the capex boom, through the big beautiful bill that I think you brought up as well. So how do you square the circle here? Though, wouldn't that
Mhm.
be reflationary and could sort of create some more? It's at least in an inflationary force, isn't it?
Yes, it is, and we are, like I said, we're already seeing some of that energy inflation in the readings uh, because of the demand. And I saw Jory talk about the PMIs and him saying this is a key thing to keep an eye on. That we're going to start seeing some more of this kind of industrial activity, you know, manufacturing activity. This is going to be important for uh, driving costs in the future. But he also talks about deflationary aspects of AI. So it's kind of tough to say how does all of this balance out in the long end because you do have these competing forces. I also think if we lower Fed funds, which we will be, that's going to be, as I said, deflationary, taking out some of this interest rate stimulus cash that's flowing into the economy. So I think at the end of the day, what you're going to see is you're going to see inflation or increases in prices in certain areas that are in exceptionally high demand, especially in connection to this whole AI movement and energy and the grid, and that it's going to be tough to get away from that. Like it's going to be hard. And then I think in other areas, like in certain services, you could start to see some real deflation. Professional services. You look at lawyers. You look at they're not hiring as many new grads because AI is doing a lot of that work. And maybe that's not as many billable hours anymore, where instead of having a junior associate spend 10 hours on something and then it gets reviewed by a more senior person who does 2 hours and you get 12 billable hours, you have that senior person spend an hour on AI doing what the junior associate would do, and then he does 2 hours of review. So you have 3 hours of higher billable hours instead of 10 lower billable hours and two high billable hours, and the net is that your attorney's fees go down. So these things, what is the actual like core PCE going to read is it's going to, I think you're going to see, and energy goes into goods inflation. So you're seeing this, you're seeing the goods inflation coming back while the services is not only disinflationary, but in some cases deflationary. I believe services PMI last month was negative. So you're seeing services deflation and goods inflation. And And I also believe, those reports are not completely honest, right? So if I'm calling for a 2.5 to 3.5% reading on those reports, in reality, that's probably more like a 4, 5, 6% inflation. And so that's actually pretty high inflation, 5, 6%. But the reports are less, and most of that's coming in one area or a number of areas. In other areas, you're seeing deflation. So these are things that we haven't really seen in the past. This is why I think, using what happened in the 1970s or 80s or even the 90s as good corollaries and saying, because X happened then and then Y occurred, saying, well, if X is happening now, then Y must occur now. You have to think about logically, does that make sense in the framework of the economy that we're living in? And if it does, great. If it doesn't, then you have to think, what is the logical outcome?
Yeah, I see. If AI will go where it is projected to go or projected to be, then I really feel like, yeah, or the AI boom as such, America really will have this electricity problem even harder, or even more. So, and you also told me offline, and you mentioned it already, like electricity, energy, that could be sort of a stumbling stone or block, so to say, and even for markets potentially, where we could see a potential other hiccup later in the year. So maybe can you address this as well? Like, there's so much, yeah, capacity that needs to be built out, for all
Mhm.
these AI inferences and everything that's will be needed, and then also for the
Yeah.
productivity gains through AI to trickle through in the end, because if there's so much demand but no supply of these chips and everything, you won't be able to use AI, so like in the end. So
Yeah.
yeah, what is your thoughts there?
Well, I do think it's the bottleneck, it's the constraint, right? It is the electricity. Elon Musk, buying power plants and all these big companies investing in nuclear. And that's going to take years to get online, right? And so we're simply not going to have the energy that we would like to have. I think that is the reality, and I think there's gonna eventually need to be, like, regulatory mechanisms put in place to handle it, where people are like, "Look, we can't let consumer energy prices go up 300%. We need to basically say, look, consumer energy, we're gonna cap these rates or do something with it, and then you hyperscalers, if you want energy from the grid, like, you're gonna be paying a premium for it." And that this type of energy constraint, um, could be beneficial in one sense, that it might slow down the pace of AI a little bit so that there's not so many quick job losses and replacements and things of that nature. But on the other hand, I do think that if I look out over the next 12 months and think, what could be something that could cause another larger pullback? Not just a 5 or 6% pullback, which I think we're starting today, or actually, I think we started it yesterday morning after hitting the high. But that something that's a larger, more of a 15 to 25% pullback, I think it could be around energy and the concern that energy is going to crimp the AI story. So that's what's been really supporting the market, is the AI story, and saying, oh, wow, this energy bottleneck is bigger than we realized. That's going to slow down. Maybe the US isn't going to be able to keep up with China, all these things. And then you combine that with, well, the energy inflation is, because that, as I said, it feeds through to everything, right? Because, one of the best correlations, and this is part of MMT actually, is you want to see what's really going to happen with inflation is look at crude oil. And I made a ex post a week or two ago that the new energy component that really drives inflation in my mind is electricity. And you can almost use, natural gas as a proxy for that. And I think you saw Trump just do a South Korea trade deal and say they're going to buy a bunch of liquefied natural gas. He's saying that Europe's going to buy a bunch of liquefied natural gas. And we do have a lot of natural gas in this country, but you start sending a bunch of it overseas, and then you look at the AI demands, because there are power plants run by natural gas. I think we're going to need to increase those. We're going to, get coal-fired plants back online. Like we're just going to be scrambling for electricity, and that's going to take time, and it's not going to be easy. And if we hit a spot where we see energy prices spiking AI companies saying we want to do X, but we can't because we don't have the energy, and it starts dampening the AI story, then I think you start to get the catalyst, the narrative that could be more than a 5 or 6% pullback that could lead to something deeper. And it wouldn't surprise me if we have one of those in the coming 12
Mhm.
months, but I do think that it would probably be a V-shaped type affair.
Mhm. And yeah, yeah, totally. And at the same time, a layman investor would probably just say, well, I mean, if there's like electricity bottleneck, that's ultra bullish for commodities in the end, commodity prices, copper, whatever you need, lithium, all these sorts of commodities that you need. What is your thoughts? What are your thoughts
Uh,
there? Is there
well,
a
we,
valid connection? And is commodity something that you want to maybe have more exposure to in the coming
mhm.
months or already now?
Yeah, I think so. I mean, I think there's some good opportunities right now with companies like FCX, Freeport McMoran, which also, along with pulling copper from the ground as part of their copper mining, they pull gold. And we got like a big dislocation in those share prices because of the Trump copper tariffs that sent copper prices plummeting 18%. And so you've got this kind of, if you're looking for a place where there's like volatility, dislocation, things that maybe they're not finished going down, but once they are, look really good medium longer term. I do like miners, BHP Billiton out of Australia, FCX here in the United States. I think those share prices, I'm not going to be buying like options on them for expiration next week, thinking they're going to be bumping, in the next 2 days. But if you're like, okay, maybe I want to take after the Microsoft spike, I want to sell some Microsoft and diversify into something else. What's cheap right now that looks good over the long term? I think some of those plays are interesting, and I'm going to be doing more research looking at that because I have been raising some cash. I did start buying some puts. I bought some puts yesterday. I bought some this morning. And so now I'm starting to think, okay, when I think the time is right, where is that going to go? Because I've been thinking that 6,500 was going to be a short-term top. We didn't quite get there, so I was a little off on that. But I did call yesterday morning, on X, like, okay, I think this was it. And to me, I think we're just ready for a pullback. I don't know how long it's going to be. Is it going to be a few days? Is it going to be 2 or 3 weeks? I don't think it's gonna be extremely long, and it could just be a matter of even days. We'll see.
Yeah. Yeah, I see. Well, Mel, I think, yeah, that's so amazing. We have to come to a close here. It was amazing again, and I could ask so many more questions, but I gotta get celebrating, the Swiss National Day. Maybe one last quick question, because that's something,
Uh-huh.
maybe a personal question regarding like you as an investor, what
Uh-huh.
are the metrics that you look at? Is it more intuition, or basically what is the data that you're trading off? Can you let us in on some of the ingredients of maybe your secret sauce,
Uh-huh.
that you have?
Well, I think what I do is I look at the big picture. I look at these narratives, that I'm talking about. Then I look into the data behind these narratives. And by the data, I'm not just meaning, the economic releases, but also the fiscal releases, the monthly treasury statement, um, looking at what is happening, in the economy with some of these big, components of the indexes like the hyperscalers, the Mag 7, different sectors. So I look at all of that analysis, and then I think what fits into this narrative? What are the areas I like and don't like because of these stories? I like commodities. I like financials because I see a steepening of the yield curve. Fed funds going down, long end not going down that much or staying in this 4.5 range. I look at healthcare. I don't like healthcare. That's been the one sector I've hated all year because I think the Trump administration needs to go after healthcare. That's what's really been driving deficit spending is the increases in medical costs. They're going after drug companies. They're going after insurers. They're trying to find ways to bring down healthcare costs because that's a huge portion of the U.S. transfer payments. So then once I get to that level, then I can start looking at either ETFs that encapsulate these ideas or individual securities. And then I can go and look at the technicals and say, what are these charts telling me? When is a good entry point? When's a good time to buy? And then make the actual buy or sell decision based on that. So it's a it starts with the narrative and the story that I think is actually happening in the economy and with money. Then it goes into more of a sector industry type analysis, and then individual securities, and then finally the technical analysis to make the buy or sell decisions.
Well, great. Well, I guess all the listeners will surely appreciate all the insights and the openness. Well, Mel, thanks a lot for doing this. Enjoy the rest of your day, and yeah, we'll definitely bring you on again in the future. Thanks a
Yeah,
lot.
no, I appreciate it, Pascal, and enjoy Swiss National Day. As we were talking about off air, for people that don't know, this goes back to, I believe you said 1291, when some cantons first decided to get together, kind of a initial formation period for the Swiss Confederation. So enjoy. And if people want to follow me, I'm Mel Mattison one on Twitter or melmattison.com. And I have a financial thriller called Quaz that gets into some of these themes that's also available wherever books are sold. So thanks for having me, and enjoy the rest of your holiday.
Yes, great. Have a great one. Thank you, Mel. Bye.